How you doing, friends? It is 0 days to expiration, episode number 56, seasons 2. And today we're going to cover profit management and the profit management framework and what it is. Is it mechanical? Is it discretionary? Can you do a mechanical strategy in a complex options trade? I guess that's the big question. I've been asked this several times in my podcast. I'm sorry, in my Discord. And I'd like people to think about what it actually means to do a mechanical strategy. And, essentially what you're saying is, can we automate a strategy? Can we come up with all of the criteria, the situations, the execution, the type of execution? Can we do all of that and do better than somebody who is trading that same strategy by hand or in a discretionary manner? So what I did was I asked ChatGPT, and the first thing I asked. Now, let me just say first of all that I've been creating automated strategies for a couple of decades, maybe a little bit more, and I was a quantitative and used many of those strategies in my hedge fund. Literally created thousands of strategies, very sophisticated strategies that were completely automated. The machine just took over. We were constantly updating and trying to improve on this strategy, trying to find the sweet spot. And really the problem with any singular strategy is that it is almost impossible to find the quote sweet spot, because conditions are always changing, and the condition that you created the strategy for may be fleeting, may be very well contained, and it might work for a particular time, but not in another type of environment. And that's really the problem. The problem is that there's no way to. Now, some people will argue that, well, you can just back test for all the different strategies and market types, and then detect the market type, and then switch your strategy or alter it to be conducive to that particular market type. It sounds so easy, doesn't it? It is a very difficult thing. One thing that I did find out, well, I can say definitively that there is no one single strategy that you could automate that will work all the time. That simply doesn't work. There are types of strategies or clusters of strategies that you can put together with a certain philosophy that can work over time. But again, I guess the real argument is, is that the most optimal way to do a strategy? So, for instance, what I have found, what does work is multiple uncorrelated strategies working together, and having a loose degree of correlation, and perhaps even doing some form of a statistical arbitrage across those correlated strategies may have some promise. But even that is really an approximation, and it's sort of you're putting on a strategy like that in order to take the discretionary part, or the subjectivity of humans and all of their frailties, off of the table. Now, that could be good, or it could be bad. One thing that I have seen in brokerages, and in most brokerages, they'll have two camps of in-house traders. They have the automated group or systematic group, and then they'll have the discretionary traders. And if you were to look across all the different brokerages that have these two different groups, and I've seen studies on this, although mostly what I'm going to tell you right now is, conjecture and what I have seen for my own two eyes, but and also studies that I have seen that maybe not complete, is that the discretionary groups tend to do better than the systematic groups. And so that's kind of interesting, because you would think that the systematic groups, with all of their big heads and incredible mathematics and powerful computers, could outperform individuals, but that's simply not the case. So, so we're getting now to our profit management framework here in Zero DTE, and some members are wondering, can I automate some of this? Can I take the discretionary part, the subjectivity part, off the table, and thereby eliminate the frailties that us humans have? I mean, there is no other reason why you would do it, right? You wouldn't do it because you felt like maybe a computer could make better decisions than you, or that the strategy that you come up with is more intelligent than you. I don't think that would be the case. You would do it because maybe you're just not good enough at trying to decide, how deeply to hold a strategy as it's going into profitability, and when to get out, when to take the loss, how to let your winners run and get out when losers are overbearing, etc. Making those optimal decisions. And that's notable, except that everybody has tried it. I've tried it. I've known hundreds of traders that have been successful in certain extent. One of the only real automated strategies that work in my realm, or my experience, are front-running arbitrage strategies, the type that might be used in high-frequency trading, simply because it is extracting a pure arbitrage in a way that a human couldn't possibly do it. The other types of strategies are what I also described as these sort of loose-bounded hedge fund strategies that, for the most part, work when they work. And, of course, there's always at some point where they'll stop working, but take on a kind of statistical arbitrage across a number of highly correlated assets. Then there's the other type that I had mentioned earlier, where you look at very uncorrelated assets that all have some degree of positive expectancy. Not that they're all perfect. They may win sometime and lose sometime, but if you put enough of these together, and you can control their correlations so that they're diametrically opposed with one another, and you can create a basket of these strategies. In general, my experience is that those types of systems are potentially very profitable, because they tend to knock off the losing side with winners, and of course winners with losers. But if they all have some degree of positive expectancy, then the average amongst all of them will actually produce a pretty good result. But is it optimal? And can it is it practical? I mean, if you're going to compare that to what a human person can do with their discretion, as opposed to creating something that is more convenience, so that you don't have to have humans involved. And when you do something like that, it requires a fair amount of computing power and know-how, and to first fashion the strategy, and then come up with the right combination of correlation, etc. So it's not an easy thing to do, but that's really outside the bounds of what we're really talking about. What we're really talking about now is, if you have a discretionary strategy that might have some rules around it, can you look at those rules and then codify it, and then turn it into some automated thing that will completely supplant you and be able to produce a better result? I mean, I'm not aware of any strategy like that. And I've been trading for quite a long time, and I'm sure that there are people out there with their own bots, and they'll tell you how great their bot is and how much money it makes. great. Just show me the money, right? Show me how it works. I'm not aware of it. All right, so that I'm going to put that aside and just say that a mechanical strategy is kind of a fallacy. Everyone's chasing after it. Everyone is claiming to have bots. I don't. Anybody that has one that actually works, why they're selling it to other people would be beyond me. So, and then behind the scenes, I've tried these for quite some time and work with people that have been developing them. And like I said, unless you come up with a large model that puts together highly uncorrelated or uncorrelated strategies, multiple uncorrelated strategies, you don't have a chance of winning with any particular strategy. All right. So now that we've handled that, well, thank you, Ronald. Ronald's welcoming me back. You may have noticed that I didn't post all last week, and that's because I had COVID last week. It's my second bout with COVID. I was one of the originals that had COVID way back in 2019, 2020, right at the end of 2019. And I had it pretty bad. This last time wasn't so bad. It was more like just a bad, not even a bad cold. It only lasted for a few days. So, but it was bad enough that I didn't feel like doing any. I had, a scratchy throat and coughing and that sort of thing. But I'm much better now and doing well. So, thank you for inquiring, by the way. So, on to the zero DTE strategy. First of all, what is it? The zero DTE strategy is a probabilistic strategy. What we are doing is we're working with an asymmetric risk to reward. We are putting out a premium collection strategy on the day that premium is probably primed to collect, because it's going to be decaying at its fastest rate and it's in the shortest amount of time. And we put on a strategy that has high asymmetry, in other words, very low risk and high potential return, and then use probabilities in our favor in order to collect some premium from that. Now, is there a way to optimize that? I'm not so sure that there is. Can you, through consistency of action and adaptability to the current conditions, can you optimize the return? I think that largely you can. Now, could you come up with an automated strategy that could basically do the same thing as a human? I think it's possible. I don't think that we could come up with a set of rules that would be human readable, that we could make the right decisions at the right time under the right circumstances. Because first of all, the market is changing all the time. The way we have approached this strategy in the different market types, from 2021 when we had the buy the dip strategy, and then 2022 where we had a strong bear, and then into the end of 2022 into 2023 we had this sort of sideways consolidating strategy, and then we have what appeared to be a melt-up strategy over the past several months, and now we have a pullback, potentially going into a recessionary strategy, recessionary market. So all of these different market types required you to alter the way that you would approach this very flexible strategy that we have. So that was the one consistent part, was that we could use the same kind of option strategy, just to vary its width and how far out of the money that we wanted, always keeping the same kind of risk to reward and exhibiting all the same positive behaviors, like very low drawdown and small volatility in the growth of the equity curve and consistent growth in that equity curve. So those are all very desirable things. Now, could you come up with a set of criteria that would be dynamic enough that it could adjust to all these different market types? And I thought about it a great deal, and I have not yet been able to come up with a consistent way to do it. Is it possible that we could create a machine learning algorithm that could do it? Now, that might have some promise. And in fact, that is something that I'm looking to implement, and but not as an automated strategy, not as something that would analyze the market and then make execution decisions based on the algorithm, but more as a helper app that would give us the best possible conditions that we could extract or take profit from. I don't know. I just wouldn't, in the same way that up until recently, I wouldn't have allowed a Tesla to just completely take over my driving. I wouldn't allow a strategy to completely take over my capital. Although the Tesla now is getting pretty close, especially over this past weekend with the demonstration by Elon Musk and FSD version 12, where it has eliminated entirely all of the human code that makes decisions and the ladder logic. And that's kind of on the same realm that I would see an automated strategy going. I'm just not sure that I would be able to feed it enough data to make it viable enough. But I think that it's possible. And that's really what it comes down to. Can you feed it enough data and enough quality data, and that represents all the different types, market types, and conditions that would happen that the machine could learn over time? You know, what is the optimal solution for entering and exiting the market? And that's really the rub. The complexity of the market and its constant undulation and change make any kind of automation, and particularly any kind of mechanical strategy based on some simplistic criteria that you come up with, completely ineffectual. That doesn't work. It just doesn't work. I mean, it's a pipe dream for a lot of systematic traders that they could create such a strategy. And I've had such strategies. Every once in a while, you come across a strategy that works for a long time and then just all of a sudden just falls apart. And I can tell you one case of such a strategy that I had way back in 2007. It was what we called the over the weekend strategy. And it was a strategy when Apple was one of the very first stocks to come out with weekly options. I thought, wow, that's pretty cool. I like the idea of trading 0 DTE on monthlies, but now I can do it on a weekly and do it 4 times a month instead of once a month. So I thought that way back then, 0 DTE was a really good idea. And so I came up with this idea to analyze Apple's price activity coming into expiration. And I started seeing patterns of behavior that were pretty interesting, that if I had taken certain types of trades within a certain period of time, going from a Thursday to a Friday, it seemed to always work. And this was aside from actually doing the 0 DTE trade. I mean, that's the reason why I started doing the research. But then I found that the same pattern would exist over the weekend and then conclude on a Monday. And what I found was that you could go long on an Apple trade as long as it was in a positive direction. In other words, it had it was trending up in the morning, a positive move in the morning from the open of the market until noon. You could take a trade before noon and then hold it over the weekend and then close it before noon on Monday, hence the name over the weekend trade. Now, I don't know why this trade worked, but it did. And it worked after backtesting it. I found that it had an 85% win rate going back 20 years, almost all the way back to and you got to remember, this was back in 2008, going back 20 plus years, going way back to the early days of Apple. And I thought that was remarkable. So I started a service. And the service traded this. It was called the OTW service. And I'm sure some of you that are listening right now may have even have been part of that service. And the service went for, I think, about a year and a half or so, where it just worked perfectly. I mean, 85% of the time you got a strong win, and the losses were well capped. So it was really a money-making service. And it just went like that for a long time. And then all of a sudden, it just stopped. Now, the big question is, well, why did it work in the first place? Could it have been maybe, Apple being one of the most widely held stocks, could have been some sort of fund rebalancing thing that was happening on a weekend basis. I mean, that's possible, but I could never identify exactly the reason why it had such regularity with this trade. And so, like I said, all of a sudden it just stopped. And it went like that for almost 2-3 months without any win. It just completely fell apart, the trade, where it had been such a stalwart for decades. And so the service obviously disbanded because there wasn't any reason to take the trade anymore. And everyone said, hey, it was a great run while it lasted. And then over some time, I think it was about 7 or 8 months later, it just started working again. Now, I don't know if it still works. You can go check it out. Just find out any Saturday that has a positive move in it in the morning on Fridays. And take a small long position and then close it at noontime the following Monday and see how it performs for you. I don't know. I'm just telling you that it worked for a long, long time, and then it didn't. It stopped working, and then it started working again. Now, I haven't checked it for years, so maybe it still works, maybe it doesn't. But that was what I would call an anomaly of the market, some kind of, I don't know, Easter egg or something that you find and you can't identify what the reason is. I'm sure if I did enough forensic work that I could probably have figured out what was the actual reason for that type of behavior. And then why did it stop? There was another one. You had to figure that out too. Those things exist. They do. In the same way that pure arbitrage opportunities exist, but usually only for fleeting moments, and then they're usually gobbled up and then rendered useless, right? But arbitrage opportunities exist like that. But there really aren't any strategies that you could take, very few that I can't think of any, quite frankly, that have mechanical criteria that you could apply and that will make you consistent money over time without some drastic change management that would have to go. And it would have to really be, I think, a neural network type adjuster that could adjust according to whatever criteria that neural net found. And see, that would be the other thing, is that once you get the AI going, it could probably figure it out and figure out a way to trade something and do well at it. But you couldn't look at it and find out why it's doing well. So so that's my feeling about automating zero DTE. Now, what is the strategy that we use in order to extract profit consistently? Well, like I said, it's built on a couple of foundational elements. One is that we use extreme asymmetry. So in other words, we are putting on small risk, large potential reward, that we place these trades in a probabilistic way. In other words, more or less in a stochastic random way in the market, and then rely on what the market's going to do. Either it's going to move towards our strategy or move away from it. If it moves towards it, it will move some degree towards it, some percentage of the time, and another percentage of the time a little bit deeper, and another percentage of the time a little bit deeper than that, each with almost geometrically greater returns available as it moves further. Of course, the higher the return, the lesser the probability that it will move into there. However, we found also that at least the small moves are enough to overcome the risk that you take in the strategy. And that leaves you with the medium size and the big moves that will make money. So it's kind of it's definitely a huge edge. And why it exists, that's a good question. Why other people haven't been able to find it, I don't know. But I can show you on my my returns that it's pretty consistent. And then as I consistently apply this strategy, my returns are starting to compound. You can start seeing them start to curve up. And this has been regardless of market type, because I've applied this strategy in, I don't know, like 5 different market types at least, and with just minor adjustments to the strategy to take advantage of or mold the acceptance of the strategy to the market type. In other words, sometimes we're in a higher volatility regime, sometimes in a lower volatility regime, and that just requires maybe opening the premium collection device more or less, respectively. And then there are other factors too that might come in play as well. So this is a doable strategy. So let me just show you some evidence of that. So we need to bring up the. So this is over the past 433 days. Now, there was another account that I used that also had similar returns. Actually, it was a little bit steeper than this, but I think that was really a matter of that type of market that made it more conducive. But this has been fairly consistent, even through increasing of the position size. And as you can see, it's just starting to, what appears at least, that if it seems to be starting to curve up, and that's what I would expect it to do. And as I start increasing the position size relative to the amount of capital that I accumulate, I expect that to start compounding. And the drawdowns have all stayed very contained. The drawdowns have stayed under 6%. And it was only until I started increasing the position size that the drawdowns started to get a little bit increased. For the longest time, they were very well contained. But I expect as the positions, as the total capital increases, these drawdowns will look small again, and they'll go back to this this initial behavior. So there is some relationship between the drawdowns and the position size. Now, here's the interesting thing: is the risk to reward that we use. The average risk to reward is almost 1 to 10. So 1 part risk, 10 parts reward, which really flies in the face of most other strategies that are used by retail traders. So we could see that it's a highly efficacious strategy that has consistency. Of course, that requires the practitioner be consistent with their approach to it too. Not only in the the strategy selection. Now, we basically use the same strategy, but there's variants of it. There is a bullish variant, there is a bearish variant, and then there is a market agnostic variant, but they're all essentially the same or comprised of the same strategy. So application of that through some sort of stochastic selection process seems to work very nicely. So it takes a lot of the human selectivity or discretionary out of equation. It does still require us to have a general bias when we're setting up these probabilities, but they seem to work very well. Now, how we actually manage profit in a strategy like this? Well, let's take a look at that. And let's see. Well, we can't actually look at it right now because I haven't plugged in my my iPad, and I've done that so many times before. But let's just say that it really comes down to if we have a butterfly that is out of the money. Now let me bring back the big head here so I can animate. So if you have a butterfly that's out of the money, out here somewhere, you know, and this represents its debit, and price is out here. There's a certain number of prices that are going to go away from the butterfly. Let's say it's 50% go away and 50% go towards the butterfly. Now, being out of money and having that risk to reward set up, there's going to be a certain percentage of them that will make small profits. So let's say that the profit curve goes like this as you get closer to the butterfly. And then if you get into the butterfly, it starts moving up and shooting up almost exponentially because of the nature of the butterfly and how it's constructed. Yet the risk on the other side is always fixed. It is fixed and it's very small. So the percentage of time that you're going to go up into the butterfly's profit tent is going to really be part of a normal distribution. And in fact, I did a normal distribution study looking at about 20 years of data. And let me bring that on. All right. And so we can look at this as sort of an inverse trip to the butterfly, where the red line here represents the zero line, and anything to the left is going to be a loss, as an example. And that's fine, because those losses will always be fixed. So it doesn't matter how big of a move it goes to the left, it's always going to be fixed. However, on the profit side, the extent of that move is going to affect the amount of profitability dramatically. As a matter of fact, as we go further out into these outlier moves, the amount of profit that gets returned from the butterfly is going to increase almost geometrically. And I can demonstrate that by showing you the actual distribution of returns on the butterfly. On this strategy, a zero DTE strategy. So here's the distribution of returns. So as you can see, it's almost an exact correlation to the distribution of moves in the S&P. In fact, that's what I was just showing you here, the distribution of moves in the S&P right here, right? So these moves that move out here start making way, way more money, while these moves make a lot of small money. But these small money moves pretty much capture all of the negative moves. And then so what we're left with that actually builds the trading account are all these medium to outlier moves, which are going to happen no matter what. All we have to do is be there to be able to manage our profit-taking strategy. So that's, so I'll go back to it. So this is the distribution of returns. Now you can see, you know, some returns as high as $2,300 for a risk that averages around $200. And, but these losses are capped. They never get bigger than that. All right. So all of these moves in here tend to offset all of these negative moves. And then what you're left with are these outliers that will happen no matter what, and they will propel your account. And that's exactly what happens here. Now, it's an interesting behavior that happens. It's kind of a sidestep behavior. You know, one of our tenets is that we preserve capital first, and then make profit second, because we are under the understanding that we can't force a trade. We can't force a big win. Most of our wins, maybe 70 to 80% of them, are going to be small. Now, when I say small, that means some multiple of the risk that we take. So if our risk is 1x, our wins are 70 or 80% of our wins are going to be averaging around 1.5x. So you can see that 1.5x definitely will offset all of the losses. So what's left over then are the other moves, and they average anywhere from 1.5x to 10x of the risk that we take. But most of the time, we're moving sideways, just these small and medium-sized wins, and then we get some big wins. Then move sideways, get a big win. Move sideways, get a bigger win, and so forth. I mean, that's really the, and then once we start adding a little size to it, you start seeing a little bit more volatility, and then some of these really, really big wins that happen, and then sideways moves, and then big wins, and then sideways moves. And this is going to continue to happen with regularity. But as we increase our capital, then we increase our position size commensurate with the size of that capital. Then those wins are going to get bigger and bigger, and therefore compound the rate at which we start making money. So that's the nature of this strategy. Now, can you automate that? That was the original question. Can you automate that? And I would say that no, that it is too complex. First of all, we cannot do market orders with options. That would be a disaster. The premium is changing, or the premium available in the morning part of the trade is changing dramatically from day to day, and from hour to hour and minute to minute. So that is a very complex operation, and in terms of capturing that premium. And then in the later part of the day, if your strategy happens to make it there, it becomes a little bit more smooth sailing, because premium no longer has a toehold on the value of your option. It's now all up to time, and time is a constant. So yeah, so because of that, and because of the way we have to kind of present the strategy to the different market types, I don't think that there's any way to actually automate this strategy. The discretionary way is a far more effective way to trade this. But as I said, I think that there is the possibility of creating a machine learning algorithm that will provide us with the optimal choice to make in terms of holding or folding a position wherever we are in the course of a trade. But like I said, in order to do that, it's going to have to generate or capture a tremendous amount of information and data, which I'm not saying is not possible, but it's just that's what it's going to take. And it's going to take a while. And like I said, I'm pretty sure that it's going to take a long time, just based on looking at the complexity of full self-driving, for instance. I know that is probably most likely a much more complex problem than trading options into expiration. But it's going to be a similar thing. I mean, where they need millions upon even billions of hours of video in order to machine learn how to drive a car in a very highly complex environment. I would say that that's probably on order of maybe 2 or 3 orders of magnitude greater complexity than actually trading this strategy, which leads me to believe that it can be done. Just it's going to be, I don't have all the data that I need. I think it's attainable, and I'd love to be able to do it. So we'll see how that all works out. But I think that just from a heuristic and common sense point of view, it totally eliminates the idea that you could actually create a mechanical strategy that I could just simply put up a bunch of static criteria and then choose that criteria and then let it run on its own and then expect that it's going to produce any kind of profit. I don't think that will happen ever. Yeah, I can't see that happening ever. Not with any static criteria. I don't think there's any way that you could choose the set of criteria that's going to give you a best result, or a result that will be any way better than a human can do. But yeah. Hey, look, if you like this content, give this video a thumbs up. Really appreciate it. I appreciate the fact that you're here listening to my diatribe here. It is a complex problem, but as far as being a discretionary trader, I figure that I'm probably at least maybe close to as smart as a computer. And that my intuition and my experience comes to play to a great deal. And then other people that learn this strategy will also impart their efforts and develop skill sets that will also allow them to make a lot of money with this strategy. So there you go. There's the 0 DTE day trading strategy. If you'd like to learn how to become a pro trader, because that's basically what we do here, we teach people how to trade at a professional level, go down below and select the trial, 4-week trial. You'll learn so much in that 4 weeks, and then to join us and go on your road, get on your road to becoming truly a professional trader, escape the retail trading hell, and learn how to actually create consistent profits, become an independent trader, trading at a professional level. Let's see, Gandalf, how you doing? That's a great name, Gandalf Skywalker. That's got to be a made-up name. Ernie, does this strategy develop on frequency of trades, like how we are trading 5 days a day? 5 days. Can one only do a 7 DTE once a week trade? This strategy, I mean, it's fractal in nature, so you could do a single weekly option. I mean, I also trade this strategy on Tesla, so it's effective there. The great part about using the SPX is that it has 5 expirations a week, and that also goes for the NDX, as well as the E-mini S&P futures, as well as versions of the SPX like the XSP, which is 1/10 the size of the SPX. There are other asset types that are candidates for this, like the Russell Index or even the Gold Index, both of which trade 3 weekly options per week. Yes, but what about 7 DT? No, that's what I was just saying. You could do... I don't see... The problem with the 7 DTE butterfly is that when you go further out, there's a law of diminishing returns. You're taking on a lot more risk in terms of time for not an appreciably greater amount of premium. The sweet spot really is in that last day. You're collecting almost 50% of the premium in just a single day. Where if you go to 2 days, you're collecting about 60% of the premium in 2 days. So you can see that second day, you're giving up a lot in terms of additional time risk for only a small percentage of extra potential premium. So that's why when you go out to longer DTEs, it becomes less viable, and why the single day is really kind of a sweet spot. Not a sweet spot, but sweeter than 7 day for sure. All right. So that's the reason. That's the reason why people are so interested in 0 DTE, because of that single day gamma stoked trade. Now, of course, we're not, we have minimal exposure to the gamma risk, unlike other traders that are trying to trade this, you know, playing off of that gamma risk and doing it in a way that is extremely dangerous. We have a much better way of doing that. See, you know, thank you. I was looking for the drawbacks to 7 DTE. That makes sense. Okay. All right. I am all done here. I want to thank everybody again. Give this video a thumbs up. This is awesome content. You're not going to get content like this anywhere else. Nobody else is trading the 0 DTE like we do. We also employ volume profile strategies that nobody else is doing, that I can tell you are taken directly from the institutions, because I was there. I took it directly. And it is an extremely effective way to trade. All right, thank you. Peace to you all. See you next time. 0 days to expiration. Bye.